everyone. Thank you for listening to our team's valuation analysis of Sun Microsystems. The reporter will be Rui Shichen, Xinhui Huang, Ziwei Chen, and Tianhao Yu. As we all know, valuation plays a very important role in corporate acquisitions. Many enterprises suffered great losses because of the high valuation of the target enterprise. As Oracle consultants, we need to help the company valuation of Sun. We will do the analysis from the following 6 points. First, we think Sun Microsystems is a good strategy fit for us. In 2008, Sun's operations were in this area and their assets were marked down. Our company with a good management team and more than 8 billion in cash could buy Sun at a reasonable price. The merge had great benefits for both companies. First, Oracle could combine its dominance in software with Sun's superior hardware systems and networking knowledge. This would expand company's range of services and customers. Secondly, Sun's excellent software systems also brought in extra revenue because some customers were willing to pay for them, and our team would also improve the quality of the softwares. Finally, Sun's hardware and software could help our company build machines that fulfills company's long-term plans. And for the second part, I will introduce the methodology. We use income approach to do the discounted cash flow valuation. Here are the formulas. Then we use market approach to do the comparable trading multiple approach. And here are the multiples we use. Then my teammate Xinhui will come to introduce the third part.
Thanks for Ruishi. In this part, I will use discounted cash flow method to calculate a proposed stock price. To do this, we need to calculate the WACC, free cash flows to the firm, and the equity value. In the first part, we use CAPM to calculate the cost of equity and use the BB Plus rating bond yield as the cost of debt. We got numbers from Exhibit 9 and 10. Also, we assume the market risk premium is 6%. Using the WACC equation, we got 12%, so we think we should require at least 12.05% on this acquisition. In the FCFA part, we need to calculate the net working capital and make some basic assumptions first. We use net receivables plus inventory minus accounts payable to calculate the net working capital. For estimation from 2010 and to 2014, we assume the ratio of net working capital to sales will be a constant number as calculated in 2009. Another assumption is that we use 35% as a tax rate, and we assume the terminal value can be calculated by free cash flows to the firm in 2015. And the numbers in red are calculated by numbers in 2014 times 1 plus 2.82% and get the FCFF in 2015. The number is 440. Then we divide it by the WACC minus terminal growth rate. By discounting all free cash flows and terminal value, we get Sun's enterprise value of 3,668. Then we add cash, deduct debt, get the equity value of nearly 4,300. By dividing shares outstanding, we get final stock price of Sun Microsystems of 5.81, which is a bit lower than the market price. Because the DCF method does not take into account changes in the market environment and people's expectations for the industry, then we want to use the market approach to calculate a reasonable price for Sun Microsystems. Next, let's welcome Ziwei.
Thanks for Xinhui. Now I'm going to introduce comparable trading multiple approach. First, this method assumes that comparable firms with the same assets will trade their goods or service at equal rates. Therefore, we can use this method to calculate our target company's value. When choosing comparable companies, we need to consider whether they have a similar firm size, are they in the same industry, do they share similarities between their products or service. After we compare the firm's product lines and service, we only keep 5 companies as comparable companies. Now, step 1. We can talk about how method apply. Calculate the enterprise value of these comparable firms using the formula on the screen. And next, step 2. Find enterprise value to revenue ratio, enterprise value to EBIT ratio, and enterprise value to EBITDA ratio. And we only keep 5 companies, so we have these results. And next, we take average of these numbers as was shown on the slides. When it comes to the step 3, find enterprise revenue, EBIT, EBITDA of Sign Microsystems in 2009. The accessible data was only for the previous 2 years, so we use the average of 2007 and 2008 to forecast the data of 2009. So, step 4. Apply 3 average numbers to calculate firm's enterprise value and equity value. Last, step 5. Use equity value divide the outstanding shares, regard Sun's stock price under 3 conditions. And then we calculate the equal weighted stock price of it. Finally, we talk about the economic fundamentals. We know that comparable company analysis is vital for computing a firm's valuation. However, this method can lead to a false estimate of company's value. If these comparable companies have solid financial positions, such as Apple and Dell, we have the wrong numbers. Next, welcome Tianhao Yu to introduce the next part.
So for the synergy effect, to verify this effect, our team considered 4 very important points. First, there will be an integration expense after the acquisition. Second, loss in the rise in the operation income will occur. Last, there will be some percentage reduction in the staff costs and admin costs. Let's look at this table to see how we get a new EBIT and the free cash flow from these situations. First, the loss in operation will happen in the first year for 45 million, so we deduct that. And the integration expense, which 750 million in the first year and 350 million in the second year, we also deduct that. The operation income increase will happen from the 2011 on. Notice that it is gradually rise to 900, so we assume the straight line. So it's from 300 in the 2011 to the 900 in the 2030, and we'll keep that rate on. So holding all else equal, we use the same method of the income approach to calculate our free cash flow with synergies. So we use the discount rate of the WACC to get the NPV of this free cash flow. Also, the terminal value is decided by the golden growth model, assuming the growth rate close to the risk rate. And finally, we get a price per share, which is 11.20. Notice that with this effect, the price is 5.39 higher than that without the synergy effect. So it's not difficult to understand why our company offered a high price of 9.50 for the Sun Micro, because it is very strong synergy effect. So we still got a final question, is that when other competing company appear to bid, what is the highest price we should give? So we combine the use of 2 methods, which is income approach and the market approach, and define different kinds of the weight. We consider the DCF model to be the best valuation technique in this case, since it considers the future change of the data and the time value of the money. Thus, we apply a dominant weighting, which is 17% to this approach. Finally, we get the highest accepted price for our company is 11.75. That's all the content of our report, and thank you for listening.